Matt, a lot of people sitting in this soft landing camp at this point based on all of the data we're getting, based on Fed commentary. It doesn't seem like you're quite ready to jump right into that soft landing scenario. Where do you sit at this point, and how do you see things playing out to start 24 here?
Yeah, really good points. Look, a couple of months ago, we would say that our call for a mild recession was kind of quasi-consensus, but over the last 2 months, it's kind of moved into the contrarian camp. We haven't changed our view that the ultimate result of one of the fastest tightening cycles in the last 40 years is going to be some mild form of a recession in 2024. A couple of things that we've been watching pretty closely. Even though the Fed is getting more comfortable with inflation rapidly coming down, we do think that it's going to be a challenge for inflation to firmly get down to their 2% goal. And so a lot of these cuts that are priced into the market here for 2024, we think it's likely to be somewhat of a disappointment as we move into the front half of this year if labor doesn't crack and we don't get the room for the Fed to cut in the front half of next year.
How many cuts are you pricing in? How many cuts are you anticipating that the Fed is going to need to move forward with next year?
Well, we do think the Fed will cut. However, we do think it's mostly going to be as a result of a deterioration in the labor markets that's coincident with a recession. And typically when the Fed cuts, they don't cut 25 basis points at a time. They tend to cut in response to economic weakness. And so it wouldn't be surprising for us to see something chunkier than what the market is pricing in, albeit for a response to economic weakness versus an insurance cut to kind of modulate the real rate of interest that's out there in the economy. So we don't have a specific number for you, but we do think it's likely to be a higher number, likely than the market's pricing in, but for reasons kind of surrounding recession versus trying to modulate a soft landing.
Matt, we're talking about rate cuts here, and one of the things that's been moving significantly over the last month has been small caps, right, in the Russell 2000 as sort of that anticipation of rate cuts has come. Great chart out from Bespoke Invest showing that the Russell 2000 went from a 52-week low to a 52-week high in just 48 days, kind of a massive move for the Russell 2000 there. Curious what you make of that move. Is the Russell 2000 still at a good valuation here, or has that move been too aggressive and we're sort of already getting ahead of ourselves from a pricing standpoint here?
Yeah, it's a good observation. And it's been a good story for investors that have been diversified in their portfolios across fixed income, equities, and real assets. Small caps specifically in our portfolios have been overweight, coupled with a defensive overweight to fixed income. And the reason why we liked the small cap trade is because we saw a lot of the weakness in small caps kind of pricing in a macroeconomic outcome of recession. And what I mean by that is you look at the earnings estimates for 2024 in U.S. small caps, those have already been marked down by 15% or so. And against those reduced estimates at the time prior to this big rally from the back half of October till now, we were only paying 12, 13 times earnings for those reduced estimates. And so to us, coupled with, overweight to core fixed income, we kind of liked that risk reward where we could be defensive in our fixed income positioning, but also, in case, this economic cycle were to prolong into 2024 longer than we expect on the expansion side, we could get a pretty quick catch-up trade in the small cap side, and that's kind of what's happened here the last few months.
Is the Russell 2000 still the best small cap trade? Because from what we've also heard, it might be best to look at indexes that have a profitability filter even.
Yeah, that's a really good point. We prefer looking at the small cap 600 versus the Russell 2000, specifically because profitability is more emphasized in that index relative to the Russell 2000, where there's a greater percentage of firms that are unprofitable. And that's not abnormal for smaller companies that are growing quickly to scale. But, with our assessment that we're later in an economic cycle, we think overweighting factors like profitability makes a lot of sense.
Matt Stucky, who is the senior portfolio strategist over at Northwestern Mutual Wealth Management. Matt, great to speak with you here this morning.